That's an option for people who just aren't going to be able to get the hours to be considered a real estate professional. If you have an Airbnb and you're doing a lot of the managing and you can meet these material participation tests, just like that, it unlocks it, and you don't have to deal with this passive activity rule like you do with regular real estate.
This is the Passive 25K podcast, a podcast built around the vision of creating wealth through passive income for ourselves and others. The idea of creating income while you sleep seems like a dream come true, but for most professionals, turning this into a reality is a different story. On this show, you will hear real people breaking passive income streams down to the basics, giving you the next steps to start your own passive income journey. If you're new to the show, my name is Kyle Reedstrom from Fargo, North Dakota, where I get to work with my team of agents and investors each day to complete our goal of $25,000 a month in passive income. Now, let's get right into our next conversation. This is the Passive 25K podcast with Kyle Reedstrom. We are the home of Passive Income University. We help working professionals with one source of income start and complete their passive income journey. Quick story, calling all Airbnb investors, especially if you're an investor looking to try your hand at investing and managing. We have some amazing conversations, some amazing courses. We have Jory on our team is the number one in the game in our region. I really believe that. So find us at p25kg.com if you're looking for next steps with that, or on your passive income journey. Click the button. Let's talk about your game plan. Today, we're talking about taxes on this episode. And yes, I am actually very excited about this. We're talking about the cool part of taxes, strategizing to help lower your taxes. The episode is called How Do Investors Lower Their Taxes with Real Estate? And our guest is the one-of-a-kind local talent, Devon Liljenquist. Devon, welcome to the show, my man.
Thanks for having me.
So, Devon, we actually met when you were younger. You were in school, getting all this accounting power behind you, all this knowledge. You've dabbled in the real estate agency side at that point, and you've now become someone that I trust with every tax question I ever have. It's not uncommon for me just to text Devon at all hours of the day and night about tax things. And Devon, you shouldn't always respond as fast as you do. You're getting married now. You need to be not be as responsive to these needy clients of yours. But Devon, you bring a unique value. You have a real viewpoint from the standpoint of an entrepreneur, from the standpoint of an investor, and I just value the way you see things. But give our audience a little intro about you, your business, and what got you to this point.
Sure. Yeah. So you hinted at the real estate background. I was anxious to get going, and so I got my real estate license when I was 18. I was still in high school. So I showed houses on Sundays and, did that whole thing. And I did that all through college. And then after I finished my degree in accounting, it was about a week before I graduated college, I bought my first accounting firm with my partners. And that was back in 2017. And since then, we've bought 2 additional firms. And now we have locations in Fargo and in the Minneapolis metro. And we do a ton of, work with real estate investors. I would say that's definitely our niche. We obviously have the ability to do other stuff too, but I would say just through word of mouth, we've ended up with a lot of real estate investors, whether that be Airbnb or regular, multifamily, single family property management. The whole gamut of that has become a huge part of our business. So now we've got multiple locations. We got roughly 10 employees, and we're coming along doing taxes, accounting, and consulting.
That's awesome. And if you are someone that's listening to this and you don't maybe have that person on your team yet, in the sense of accounting or tax strategy, or even filing your taxes, I really want to use this as a nudge to find your tax person, find your person, find this person that you can ask these questions to and really understand this stuff. I think taxes kind of falls under the I'm going to be ignorant about it umbrella. And I hope some of this podcast is to bring some of those things out, the uniqueness and the awesome strategy that exists with taxes. But let's start with the basics, Devon. Think of people that are listening that just are earning a W-2. There's that tax life. And then there's kind of the tax life when you own a business and beyond. Talk to us about the differences there and how that kind of transitions.
Yeah, there's been, and everyone's familiar with, politicians talking about the simplification of the tax code, and they've attempted to do that, and they just really haven't. And frankly, when you simplify something, sometimes it makes it less fair for the people with, quote, simple things. And so what I tell people is, if you are just a W-2 earner, you are probably in the least favorable tax situation available. You have the least amount of tools you can use, hardly any flexibility. I mean, there's not much you can do to reduce your taxes beyond the stuff that's very simple. The contributing to your 401k, contributing to an IRA, HSA, the quote boring things. They're still very good things and they're very effective, but they're very limited. You're never going to be able to have the same flexibility in your tax situation that someone who owns a business has. And so business owners have all the perks. They have all the flexibility. There's much more that I can do as an accountant with a business owner in terms of being strategic on what we're deducting, when we're paying tax, because, you do have a little bit of flexibility in when you have those incomes. You can accelerate deductions within reason. You can accelerate or pull back on income and have it in a different tax year. Once you own a business in some form or fashion, that's where you and your tax advisor have a lot more flexibility, and all the benefits and breaks go to business owners. Because if I can go back a second, the government doesn't, obviously they want to raise revenue through taxes, but it also has another function, and that is to direct the resources of the country. They know that if they give benefits for investing in a certain type of asset class, more people will invest in that asset class. That's why you see a lot of benefits for real estate. The big oil companies have created benefits for oil and gas. There's just recently been even more benefits for clean energy. And so you almost have to stop thinking of the government as your enemy and more of an ally, because frankly, they're not trying to, everyone uses the term loophole. They're not trying to hide these things from you. I mean, they're mostly in plain English right there in the revenue code. It's not some secret that they're trying to hide from you. They're very clear on what you're allowed to do and what the government would like you to invest in or do.
I am super fan of where you just took this, because I wanted to bring this up later in the podcast. But what you just said is, everybody thinks of taxes as black and white. What you just said is very like, hey, there's flexibility here. There's favorability. When you said the quote of the W-2 earner that's listening to this, hey, W-2 earner that's listening, raise your hand right now. You're in the least favorable tax position. And Devon, simply starting a real estate LLC and investing in real estate, for example, is the start of a business and walking towards maybe some of those more favorable terms you're talking about. But I want to address the moral dilemma that comes up with, you said the term loophole. I've heard this. I've heard people have a lot of tentative nature around exercising tax strategy because it's kind of morally like, no, we just need to pay our taxes. It's just black and white. We get charged taxes, we pay them. When what you're saying is, one of the jobs of the government is to direct the resources of the country. One of the jobs of the government is to make pathways for people to entrepreneur and do what the government wants you to do. I've heard it called partnering with the government, some of this tax code. Mm-hmm. Expound on that a little bit more. I really think that's an interesting paradigm shift for people when it comes to taxes.
Oh yeah, the paradigm shift of just partnering with them and doing is that what you're getting at?
Yeah, like the government is our friend. The big bad government and the big bad IRS is more of like I don't want to talk to you. I don't want to have anything to do with you. Rather than what you just said is, they're actually creating alliances with us as entrepreneurs and business owners.
Yeah. And if you look at the whole text of the Internal Revenue Code, I've got it here on my desk, and it's the same thin paper as a Bible, and it's about as thick as a lot of Bibles. Most of that text is on how to not pay taxes. It's not, and I don't mean in a shady way. I mean, you're allowed to deduct this, you're allowed to deduct this. If you invest in this, you can save tax. So yeah, they have things that they feel it's necessary for taxpayers to invest in, and they subsidize that in a way. And so if you understand that, you're by no means are you doing anything shady. And I certainly wouldn't go on a podcast and promote doing anything shady. So I mean, you could take it from me that you can do tax planning and tax strategy without doing anything that is going to put you in hot water if the auditor comes. All it comes down to is, is it a legitimate business expense, and do you have substantiation for why that is? I mean, there's always people that take it too far, but there are very legitimate ways to defer or avoid tax within the bounds of the Internal Revenue Code.
That's amazing. I love this. And I'm loving that we're recording this, because this is so important. This is what, this was an epiphany for me about 3 years ago. Somebody said it in some of the similar ways that you're saying it, Devon, and it was a big aha for me. Now I want to get dirty on this. How do we actually lower, I've heard deductions, which is, if you're spending money in your business. Let's just rattle off some quick hitters on some of the categories in which you can start to lower that taxable income to reduce your tax burden.
Sure. And I'd say there's different classes of them. So deductions is one that, in my opinion, it's fine, but you're not coming out ahead on it. So, and what I mean by that is, yes, you get to deduct business expenses, but you also spent that money. So
yes, I love that.
The question that kind of sometimes makes my gears grind a little bit is when people ask me, well, how much should I spend? I'm like, don't spend more than you need to spend or want to spend. Now, so yeah, it's like you spent the money, you're still out the money, given you got to deduct it. So I always tell people it wasn't for free, it was on sale. And I think, I don't know if it was on HBO or there's a show where he's like, well, it's a write-off. The write-off people pay for it. And it doesn't work that way. It's nobody reimburses it for you. You get it's basically a deduction. So obviously your legitimate business expenses, make sure you deduct those. And then there are things that are I call them borderline personal, that the government allows us to deduct. And what I would call those things is like health insurance. That's not necessarily a business expense, but the government allows you to deduct it if you're self-employed. So those are the ones you got to watch out for, where you might not normally think about them as an expense, but the government allows you to deduct them. But besides that, it's anything that's ordinary and necessary is what the IRS says. So I tell people, if you would not have had this cost, if not for having this business, then it's probably deductible. So for me, if I wasn't doing taxes, I wouldn't go out and buy tax software. So that's a legitimate expense for me. So you always got to do that. Now, as far as deductions, the 2 or 3 that the IRS looks very closely at, and you should have extra substantiation for, is meals, because there's a personal component to every business meal. So you should have good records on what you talked about, who you were with, why it was necessary. Travel is another one. You should have records of what you did while you were on that trip, why it was necessary for business, and then automobile expenses. Everyone loves to, purchase the new Range Rover or whatever at the end of the year. But in order to deduct that as a legitimate business expense, you got to make sure you got mileage logs and records showing the business versus personal use. So that, in my opinion, is the low-hanging fruit. It's not the best benefit out there for taxes. The one where I say you get to have your cake and eat it too is retirement. Now, this is an example of something the government subsidizes. They subsidize it because if you and I fund our retirement accounts well enough, the way the government sees it is, then when you're old and not able to take care of yourself, the government is less likely to have to step in through some sort of social safety net program to take care of you. So that's why they subsidize retirement contributions, whether that be through 401k where you get to deduct it now, or a Roth where it's not deductible now, but it grows tax-free. So that is in my opinion, the gold standard, because that's the only one where you move money from one pocket to the other pocket and you get a tax benefit for it. And if I got a new client sitting in front of me and I say, well, you can go buy this shiny new GMC Denali, or you can put money in the retirement account, they usually, the shiny object is the new vehicle. And, there's a time and place for that. So I'm not ripping on people when they do that, but make sure that, you recognize the one has a little more future benefit. The kind of hybrid, I would say, is real estate. Because with real estate, you're allowed to depreciate the asset. We all know, at least historically, that real estate in the long run appreciates. So you get to depreciate an asset that's appreciating. And specifically, let's say you buy a property for $200,000. You get to deduct that through depreciation over 27 and a half years. Well, that property is going up in value generally every single year. The only time you have to recognize that gain is if you liquidate those holdings and it turns into cash. So it's kind of an unrealized appreciation that you get to depreciate. And that's why, the average person doesn't have the ability to go invest in oil and gas or, start a electric car startup, but the average person can invest in real estate. And so that's the type of asset class that normal people have a lot more ability to get a hold of. So that's the one that as I said, I've kind of focused my business on and have built a niche in, is because it's an appreciating asset that you get to depreciate. And then finally, this is probably more recent, tax credits. So when I talked about deducting something that decreases, the amount that you have to pay tax on, so it's like a discount, a tax credit is literally the government giving you a dollar for dollar. This will reduce your taxes by this much. So most recently, they've expanded the electric vehicle credit. So certain electric vehicles, you buy them, you get a dollar for dollar tax credit. I believe it was around, depending on how long the vehicle's been around, it's up to like $7,500. And so that quite literally is a direct transfer from the government to the taxpayer, because it reduces your taxes dollar for dollar by $7,500. So that's a lot there. So maybe you want to, I don't know if there's spots you want to jump in and have specific questions on.
No, Devon, I this is exactly what I wanted to talk about. And so understanding this, and again, I even get lost in some of the tax stuff, right? This is why I wanted to break this conversation down. The deductions piece that you mentioned is so awesome. And I want to use it like a vacation. Let's say you've got a $10,000 business conference in Mexico. And, you'll hear the comment. I'll hear the comment. Well, it's deductible. But it's not like you didn't have to write the $10,000 check, or put it on your card and pay for it when you get back. Or if you're planning, you prepaid for your vacation. That's what we talk about sometimes. But I want to understand. I love how you used, it's not like you just got this for free. You still have to spend the money, but it's kind of on sale as a deduction. What that means to me is now, after being educated and having Devon on my side here, I'm spending $10,000, but now my taxes might be decreased because of that expenditure. So maybe I have to pay $800 less in taxes because I deducted a $10,000 vacation. Is that kind of the way to think about this? Like this?
Definitely.
Yeah,
and they, within reason, they want you to separate that personal and business, but they recognize that it's nearly impossible. So, I mean, for people listening, I got a pen in my hand right now. I will admit right here on air that I wrote a personal note with this pen. I also deducted the cost of this pen. I'm not going to go, you know what I mean? It's impossible to separate that personal and business. So even the most honest person is undoubtedly going to have some borderline personal things that they're allowed to deduct. And basically they receive a benefit free of taxes. Whereas when you're a W-2 person, even if your employer required you to go out and meet a client and pay for dinner out of your personal pocket, this is why I get frustrated when I hear the simplification of the tax code. Part of the simplification was removing the ability for an employee to deduct that. So I see a lot of this in sales. So if you work for, medical device is a very common one where, you might go take clients out for supper, and it could be an expensive supper. They simplified the tax code, so government doesn't care. There is no spot that an employee can deduct that. So even if it's fully legitimate expense, no place to deduct it. When you're a business owner, that's different. And you, like you said, yeah, it's on sale.
Yes. Yeah. Yeah. And the differentiation, that's deductions because it's lowering the income I made because I'm deducting it and then I'm paying less on that income. Retirement is truly the transfer. Like you said, you can buy this or you can put it here for future. So you're not really spending. It's money you already have that you're choosing what to do with. And, if you put it in your retirement, that asset's probably still growing. I want to get into real estate a little more specifically and really dive into that. But then the tax credit piece I really like, that's literally, Devin, this is like if I got a $7,500 tax credit, it would be like I owe $25,000 in taxes and now I only owe $17,500. Is that correct? That's how tax credit works. Okay.
That's correct. Yep. Dollar for
All
dollar.
All right. We're breaking it down, man. And can I stretch you on this? Any other really unique tax like credits or tax deductions out there? I've heard things like hiring your kids as part of your business. I've heard things like if you buy certain vehicles, there's other deductions or credits. Like anything off the wall there that's kind of hidden in the tax code?
Oh, wow, man. One that comes off the top of my head that I've only ever done this credit once, but it's one that I know is available. You get a tax, I don't remember the amount, but you get a tax credit if you adopt a child. So there's an adoption tax credit. Vehicles is one where what you might be thinking of is you have a little bit more of a depreciation ability on heavier vehicles. That's the one you see a lot. Anything that's got a gross vehicle weight rating of over 6,000 pounds is eligible for accelerated depreciation, where anything below that is considered a luxury car. So, I mean, not to rip on Honda Civic owners, but according to the IRS, a Honda Civic is a luxury car. And so you don't get the ability to deduct that as quickly as you could, a Ford F-250.
Gotcha. Okay. Yeah, and that's the interesting part is really understanding what all of those pieces are in your tax buffet line of strategy that you want to use. And the number one thing I'm going to want you to leave with is, if you don't know this stuff, if you're not reading that tax code, start to partner with somebody that is. That's such a huge part of who, not how on this thing. And the one thing I want to end this first half with is a little bit of that conversation around the expense clarity. Because I mean, there's some people out there that are like, hey, I need to collect every receipt. And then there's some people that use one card for things like, and you're like, you said you really want substantiation. What advice would you give us business owners that are kind of operating that way and want to make sure we're not breaking any rules and partnering the right way?
Sure. And I mean, we should probably put this in the show notes, but I mean, just to be clear, this is general advice and, everybody got to cover my rear end, but everybody's situation is different. So don't rely on this wholly, but generally what I tell people is if you get in a room with the IRS, they're going to look more closely at certain expenses versus others. So for me, if I spend money at, CPAinsurancecompany.com or whatever, they're not probably going to look at that as much because they say, oh, it's clearly insurance. If I don't have a receipt, they might let it skate by. So there's a lot of auditor discretion that the people don't realize. So it's important to have a charming CPA who can make them feel at ease. So they won't look as close at something like that, and they might let it go by if you don't have a receipt. Things that they'll always want a receipt for are fuel, meals, because they want to see what you talked about, and then big box stores. So if you go to Walmart, you can buy just about anything at Walmart. So they're going to want a receipt for that so that they can see what you bought there. What I tell people is the likelihood of audit is very low, so don't stress yourself out preparing for it in such high level detail. Make sure you know where all of those receipts are, maybe catalog them by year, but by no means do you need to go through and create a color-coded binder that's got every single category and as long as you know where they're at, make sure they're cataloged, or not cataloged there, but they're stored there so that if we get audited for that year, we can pull that box and we can catalog it and make it pretty. But, don't go to the trouble of stressing yourself out over it. And as long as you got the lion's share of receipts, they're going to be pretty lenient in my past experiences.
In quick hitter here, Devin, you've been involved as in your position in representing or like being alongside people that have gotten audited by the IRS?
Yes, I have. Yep.
Yeah.
Yep.
So, I mean, you've seen this. I think that this is mystical for a lot of people. What's that experience like? Like, what's involved? I mean, is this like the big bad IRS comes knocking on my door, or how does this all work?
And, you know, I've noticed it depends on who you get. You know, some people are very agreeable. And in my experience, some aren't as much. If you give them stuff before they ask for it, meaning you come to that first meeting with all the bank statements ready, all as many of the receipts you got as possible ready, they're a lot more lenient. A lot of them are very nice people, so it's too bad they get a bad rap. Obviously, there's within every job there's the bad apples, but it can be fairly painless. And if you have decent records, it's no problem. And sometimes for me, once it's over with, it's kind of fun because I get to see like, here, we did this and it was, it stood up to the audit and we're moving on.
Yeah, it's the true quality check of how things went for that business owner and for the accounting relationship. Super cool. And I mean, that involves, how you get audited is kind of randomized, right? But then they'll reach out, there'll be some kind of interaction virtually, and then there's like an interview, IRS interview, that type of thing, in person usually.
Yep. Yeah. They've got an initial document request, and usually you bring those documents to the meeting. And then in the meeting, they ask you a certain questions depending on the type of audit. A random audit has a bunch of off-the-wall questions. They'll ask you whether you have a business. It doesn't matter if you have anything related to this on your return. They will always ask it if you have a business in the tanning bed industry, because there's some specific federal excise tax on tanning services. So they'll ask that. They'll ask whether or not you ever barter for services, meaning no cash exchange, meaning I'll do this for you if you do this for me, because that's technically a taxable transaction. So that's the kind of stuff they ask in the interview.
Gotcha. Well, we're off to a great start. I'm loving where this is going already. I want to dive in after our little break here on the real estate stuff. I had an experience with Devon this last couple of years in how to utilize real estate for this. And we'll get into that after the break. Hey gang, really hope you're enjoying the episode. I want to take just a little bit of time to highlight another episode that we have, episode 35, Freedom Through an Online Business with Sophie Howard. We shot this episode and got super excited about the offer that she had to provide, which is a community and a course teaching you how to buy an online business and create a truly passive revenue stream. When it comes to the passivity scale, Sophie's stuff is all the way 100% passive. She's living a fully passive lifestyle right now, doing things that she loves and working in businesses that she's really passionate about. And so if you haven't yet, check out that episode 35. And if you're curious about Sophie's program, there's actually an affiliate link in the show notes of that episode. You obviously get Sophie's course in her community, but it also helps us fund the operations we're doing with the Passive 25K podcast and helps us achieve our passive income goals too. So we think this is cool synergy. We think it's great value for us, for her, and for you as someone that's looking to add a revenue stream. Definitely check it out. And now back to the show. We are back on the Passive 25K podcast. Our episode is how do investors lower their taxes using real estate? So in the second half with Devon here, who's been shedding light on all things taxes. And trust me, it's been an exciting conversation so far. Really interesting. And we're keeping it simple here. And I want to talk about real estate investing and how this can be utilized. So, Devon, this is kind of a you and me story because I remember reaching out and be like, hey, Devon, I know some real estate guys that are utilizing their real estate in a little bit different way to really lower their tax burden each year. When you hear about the ones in the news, you hear about there's controversy behind it even. But I was like, what do we know about this? How can we look into this? And so I had an experience where, we own some properties, some long-term, short-term rentals. And Devon had asked, do you plan on owning these for a while? Are there a few properties you'd be willing to accelerate the depreciation on? So I really want to stay granular with this. Devon, on a normal real estate purchase, so you buy a property. Let's call the property. It's $270,000 because the 27.5 is the normal depreciation. So my understanding of this If I bought a $270,000 real estate investment, you as the accountant would tell me, Kyle, you're allowed by the IRS to depreciate this on standard depreciation for 27 and a half years. So I'm able to slowly move that basis down on that purchase. It would be $10,000. I'd get a tax benefit from that each year. Correct?
That's right. Yep.
So if I made $150,000 income and that was my net, now I could use that property to only pay taxes on $140,000 of income, right? Because I had that property. I used that to reduce my taxable income.
Yes, with an asterisk, depending on the source of income. But yes, just put it simply, yes.
Yes. So yeah, okay, fair. So my understanding is, okay, that provided me a benefit, but it's relatively minor. It's good, but in order to get a huge benefit from that, I'd have to own 15 more of those houses, standard depreciated at a standard rate. However, there's this thing called accelerated depreciation that you can utilize through what's called a cost segregation study on that property. This is where I'm going to hand the baton over. I want you to walk us through why this exists and how you can use an accountant and a cost segregation study to take that from 27 and a half years and really, accelerate that depreciation on a property like I used in the example.
Yep. Yeah. So with the IRS, they're going to, by default, they're going to go with whatever keeps the most money in the government's coffers. So when you buy a property, the building is worth $270,000. That's your depreciable basis. And by default, that goes on a 27 and a half year schedule, which, yes, it is it's a little bit longer. It's a nice benefit, but it's nothing life-changing. What a cost segregation study does is you get data on the property and you put a value on the things that the government has said can be depreciated over a shorter life. And they're generally non-structural things that, don't, an example would be a ceiling fan or certain types of flooring. A fence is under a different one. So based on
appliances in the kitchen, right? Yep.
Yep. And so you as part of a $270,000 purchase price, odds are you didn't buy a house that's just a shell. If it was just a shell and it just had studs and drywall and nothing else, well, then the cost seg would make no sense because it's all structural. It's the other things that can be accelerated. And so you assign a value to that. And instead of taking that over 27 and a half years, you can take it over 5 or all at once with bonus depreciation. And so bonus depreciation means 100% of the cost the first year. That is starting to phase out. So right now that's at 80%, but it's still, you get 80% of it year one, and then the remaining 20 is over 5 years. So all you're doing is taking deductions that you would normally get to use, but you're using them sooner. And so why that's beneficial is because if you can reduce your tax now and save $20,000, $30,000 worth of taxes, that $30,000 can be invested and make you more money along the way. I mean, it's people that went into any sort of business or finance understand the time value of money, in that I'll take the money now because that gives me time to invest it and earn money on it. And why I had, the catch with it, if you'd even call it a catch, it's just something to be aware of, is if, let's say the building value is $270,000 and we take $70,000 of depreciation, that gets subtracted from your basis. So now your basis in the asset is $200,000. So if you sell, your gain is taxed based on your basis, which is now $200,000. So if you sell it for $300,000, although you only sold it for $30,000 more than what you bought it for, you have to recapture that $70,000 of depreciation that you took. So and that's why, I had asked you how long you had planned on keeping some of these, because it isn't quite as beneficial, because then the tax deferral is only a couple of years and you don't have as much time to make up for it.
Yeah, and if I went and if we did this and we're cheering in year one because we didn't have to pay as many taxes because we accelerated, but then in year 3 I go and say, out of real estate, selling all my properties, all of that would come back and follow me, and I'd have a way larger tax bill that year with all those capital gains. So you really have to have in your mind, like, hey, what are some assets that you really can see yourself owning for a long time? Can you utilize them for some tax strategy? And there's one other piece of it that if you do sell, you can utilize a tax tool called a 1031 exchange, which maybe people have heard of a 1031. They've heard people say that. Devon, can you explain that to us a little bit?
Yes. Yep. It's called a like-kind exchange, and it doesn't mean, originally, a lot of the tax code has some interesting history to it, but originally it was for things like, I'll trade you my horse for your tractor. They would say, well, you don't have to pay tax on that. You just keep your same basis in the tractor as you had in your horse and stuff like that. So it was a break to allow people to exchange things without having to pay tax on it. So what a 1031 does is you sell the property and you have to buy something of equal or greater value, and you have to use all of your cash proceeds, and that defers the tax until later. And it's it's allowed real estate investors for years to be able to grow their portfolio tax-free. And the big one, what happens is when that investor dies, if they did their estate planning right, and under current tax law, because mind you, this last provision is kind of under attack by, people trying to raise more revenue, you can get your basis stepped up. And what that means is, let's say you have this $270,000 property. Let's say you keep it for 35 years. So regardless of whether you did a cost seg or not, you depreciated that thing down to zero. So if you sold it the day before you died, you owe tax on whatever you received because your basis was nothing. Under current tax law, if it's titled correctly, when you pass away, your heir receives that asset at fair market value. So let's say it's worth $600,000 now. Your heir can sell that and they don't pay tax on it. And so
wow. Their basis would jump from zero to market value, which is now 600. And they could also just keep it and start depreciating it again, correct?
That's right. Yeah. Mm-hmm.
Wow.
And it's very, it can get screwed up if you do certain things with your estate. Like if, let's say before you die, you gift it to your kids, then it's all shot. You don't get the step up. And that does happen for, different estate planning reasons. So but you can see why some people are upset about this because, there's all these capital gains left on the table. But if you can take an advantage of it, it's excellent. And there are the phrase people use is defer, 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 and die. Because if you defer long enough and they get that step up, nobody ever pays that tax.
Gotcha. Interesting. And Devon, one of the key components here that we mentioned was this cost segregation that has to be performed in order to. It's kind of like a report outlining the different depreciation schedules of these things, like a refrigerator. I mean, correct me if I'm wrong. It's non-structural stuff, so you're not doing land, you're not doing concrete necessarily, but like siding, windows, shingles. Some of these components that make up the house, are those on this schedule?
So they have a whole list of court cases, and sometimes they contradict each other. But like concrete actually is not considered, at least the foundation is structural, but the driveway is not. The driveway is considered a land improvement, so that's shorter. Certain types of flooring, if you try to make sense out of what the IRS came up with for what's structural and what's not, your head will start to spin because, frankly, I mean, that's the thing that's frustrating is they would treat most like siding and stuff as structural, but you could rip off the siding and the house is still going to stand. You know what I mean?
Yeah,
so there's something. Yeah. It doesn't always follow rhyme or reason, but yeah, there's different things. And I should probably get into it. Here's the part where everyone's excited, and then I'm going to probably bring them back to reality a little bit. Is the reason it works so well with you is because you're what's considered a real estate professional, and you can usually trace any sort of tax code back to the government saw someone taking advantage of something and they didn't like it. So in the 80s and stuff, there was a movement where high earners would go invest in real estate. High earners, doctors, surgeons, lawyers, all that stuff would go invest in real estate. They weren't actively involved in it at all, They just gave someone some money to go invest in real estate, and they would do stuff like this and take a paper loss and reduce their income. Government didn't like that, so they created what's called the passive activity rules. And real estate is considered per se passive, meaning it is passive unless you prove otherwise. And in order for it to be non-passive, your income has to be below a certain level, or you need to be a real estate professional. For most people, I'm going to double check my figure on the passive activity rule. I think I know it, but I want to remember the figure so that I give it right.
And I'm super glad you brought this up, by the way, because this is a huge component of utilizing this tax strategy. Yes.
Yeah. So it starts at the phase out is done at $150,000 for a married couple, and it doesn't actually go. So it doesn't go to 75 for a single person. So a single person is 150. And if you get married, it's still 150. So if you and your spouse are both high-ish earners, getting married could remove that. So even if, let's say you're making 300 grand, even if you are so actively involved, you're the property manager, you're doing the maintenance, you're doing everything, doesn't matter. If you're making over that 150, that loss gets trapped on your return. Doesn't mean you can't use it. It just means that it can only be used against passive income. So if you have another rental property that's kicking off income, those two can net together. But unless you are a real estate professional, it's lost. So that's why if somebody comes to me and they've got a high W-2 job and they want to do this, I tell them, unfortunately, back to what I said at the beginning, you're in a tough spot and the fun stuff, it's not allowed for you. So it just gets trapped, and that benefit, that time value of money benefit is gone because that loss just gets trapped until later. So that's a really important one to keep in mind. And that's why, I know your podcast isn't geared towards real estate agents, but if you're a real estate agent, you got to be investing in real estate because first of all, you know this, your boots on the ground in the market. Nobody's going to know the market better than an agent that's in there day in and day out. Even an investor that, tries to keep up on it, they're not going to be as good as somebody who's in and day out. And then second of all, a self-employed real estate agent is normally considered a real estate professional, and so they can take advantage of it. And a question I get from people is, well, I still spend, 500 hours a year doing this. It doesn't matter. So if you work 2,000 hours a year at your other job and you work 750 in real estate, it doesn't matter because the 2,000-hour job is the majority of your time spent. So that's a big one to keep in mind. Where I've seen it is sometimes if a spouse didn't work, if they can become more involved in real estate, sometimes that can unlock those losses. But it's definitely an important caveat to remember.
Yeah, they're just tracking the majority of your activity, so there's not really a way to fake that. But I do want to, real estate professional is somewhat vague here. I'm wondering, somebody that's a property manager, real estate professional, right?
Correct. If they're self-employed. So
okay,
if they're working for somebody else, generally not. So they got to be self-employed.
And then what about things like trade, home builder, in construction? Yep. Real estate professional. That goes into all the subcategories of a roofing contractor.
Yep. Generally they're okay with that. Yep.
Yeah. I can see where there'd be some there's the gray area of hey, how big is that funnel, right? But that's a good question to ask. And I want to preface this, this should never be things you're figuring out on your own, especially with the cost seg. You actually, Devon, you have to go through a CPA to do a cost seg. Is that correct?
No, so not a CPA necessarily, but we use a company that has a software.
Yes. That
we use for 1 to 4 units. So I wouldn't do it, say, on a hotel or anything, because that's kind of a niche thing. There are companies out there that strictly do it for hotels and other types of property, but for single family 1 to 4 units is what I'll do. And then I refer out anything that's going to be, commercial generally is going to be a different type of person who just does that.
So, for the income earners out there, that are now, this is piquing their interest, saying, hey, this seems like a strategy. Let's use an example. I love examples. Let's say there's hey, by the way, insurance real estate professional, that's just insurance, right?
That one's actually a good question. There might have been a court case on that one. I don't remember how it shook out.
Okay.
I know that there was an appraiser. I believe they allowed an appraiser to be considered a real estate professional. I think you could make the argument that I don't know. I could see it going either way. It's very facts focused.
Okay, so I want to take an example. I want to see I want to challenge you as the accountant to see how we could strategize this situation. Let's say I am a medical salesperson, okay? And let's say I'm making $300,000 a year, okay? My spouse is not working, and I'm listening to this podcast. I'm saying, hey, we have an opportunity to lower our taxable income. How low can we go? I mean, you can go all the way to zero with this thing, can't you, Devon?
Yeah, as long as you have the assets to purchase enough properties to do that. And I think, as an aside, that's the important thing is, in order to have the assets to do a cost seg or to purchase property, you would have had to either inherit money or have had to have paid tax on earnings throughout the years. I don't have a guide on how to inherit money. If I did, I would take advantage of it for myself. Yeah. But kind of the whole death and taxes thing is partially true. So you kind of got to take your lumps while you can, and then if you have the assets to do it, it's definitely attainable.
So I'm sitting here as this medical device salesperson. Because of how I run my business and office space and everything, and how much I'm spending throughout the year to operate my business, I was able to deduct half of my income. Like with everything, justifiable expenses. So now my taxable income is $150. Okay. Now I'm interested in talking to you and saying, how do I not pay how do I strategize, partner with the government, direct these resources? I'm going to use these terms, in order to really get this down to zero. And I have a bunch of savings. I've been a good saver throughout the year, so I can deploy some capital towards assets. What would you say?
Oh, you say this medical salesperson is self-employed?
Yes.
Okay. So the first one I'll go back to is make sure your retirement's funded, because that's the low-hanging fruit. That's the easy one. And then second, to keep with the topic we're talking about, oftentimes if they've got the stomach for real estate, because not everyone does, it's a more high maintenance asset class than going and just buying some stocks on the stock exchange. As long as they got the appetite for it, that's where it makes sense. Now, the med sales guy, he's already got a full-time job, so he's not going to qualify or she will not qualify as a real estate professional. Their spouse, on the other hand, if they have interest in it, they could qualify. And if they have no other job, kind of the rule is 750 hours per year, if they have no other job. So that spouse would have to, you'd have to have enough property for that spouse to be able to spend that much time. And the important one that's worth noting is researching for a new venture doesn't count towards that. So because I hear that a lot as well, we went out and looked at property, or we did, and that doesn't count. Actively managing stuff you already own is what counts. And that doesn't mean you need to be the property manager, but there has to be enough for you to do to manage, to spend 750 hours on it. So whether that's bookkeeping, coordinating contractors, maybe there's some property management, and we would have to substantiate that with some sort of log of what you did each day. And most people keep a calendar, and so that's an easy place to start. But that would be, if they've got a spouse that's willing to and has the interest in it, that's a no-brainer.
Gotcha. Okay, so then in this example, we've said yes to that. Now, I've still got this 150. We're going to go and buy, if I wanted to, could I buy one property and do this? Or would I need to buy a couple properties? Because, we're talking, I'm going to try to depreciate. With the bonus, I could get it all down in 1 year, correct?
If enough of it probably wouldn't, if you bought a $150,000 property and you have $150,000 worth of income to eat away, probably wouldn't get it down to zero. But you can get it down quite a bit. I think the trouble with if you bought one property is you would have to be able to say that this one property takes up 750 hours of your time.
Gotcha. Okay, so then because of that strategy, I'm sitting here saying, hey, Devin, we have capital to go buy 3 $250,000 properties. Yep. So now we're going to buy, we have to have 20% down to do that. So we're going to go and spend $200,000 of our cash to buy $750,000 of real estate. Now you're able to, cost seg that and depreciate all 3 of these partially. Got enough time invested for the 750, and we could get that tax bill all the way down.
Yeah. Yep. You certainly could. Yep.
And then, if I'm planning on doing this again next year, because I liked the situation, we would still have some depreciation left in these 3 houses. Mm-hmm. And then next year we could have a goal of acquiring maybe 2 more, right? Or even 1 more, and then kind of doing that. And this is what the cycle that a lot of real estate investors do with tax strategy.
Yeah, because as long as you're continually growing, you'll continually get the benefits. If you stop growing, you just won't get those additional benefits anymore. You might end up, paying some tax, which at some point, some people gotta either stop or throttle back. There might be years where you do that, but yeah, the government's going to subsidize as you're growing your business, and that's real estate or any other business too. If you own a farm's a great example that a lot of people are familiar with. If you're growing your acres that you're farming and you're buying equipment, they'll subsidize that. And once you stop, it's not that they're not subsidizing, or it's not that they want you to stop growing, and they're just not going to subsidize you to just sit there. So yeah, as long as they're comfortable doing that, it's definitely an option.
Man. Well, I hope this was bite-sized. I hope people are chewing on this. This is much more exciting tax conversation. I love it. And I think that this can be utilized. You guys, so one of the best ways to improve your personal cash flow is to have a lower tax bill. Keep more of the money that you make. That's an amazing way to create higher savings rate. If you think of the tax bill of anybody that's written a tax bill of $40,000 to the government, it's kind of painful. And if you can strategize and keep some of that money, and like Devin said, time value money, and deploy it, this is how you really get the multiplier effect on your wealth creation and your passive income journey. So, Devin, we really broke down some complex stuff, but I really feel like we made it simple. I really appreciate the way you approach this. Dude, you have been an absolute tax ninja in many parts of my life, and for people that I know. Dude, sharing these insights with entrepreneurs is crazy helpful. So thanks for being knowledgeable. Thanks for sharing like you do. Yeah, thanks for coming on the show, brother.
You bet. If you've got time for one more, there is one that I think is going to be really relevant to your listeners, because I know you've got a lot of, you've done several podcasts between Jory and Noah, and I think some others on Airbnb. That one is unique because God forbid anything be simple in the tax code. Anything where your average number of nights is 7 nights or less. So if you've got, traveling medical professionals staying for a month or 2 months at a time, this doesn't apply to you. But if you've got people staying for 3-4 nights on average, there are different rules for short-term rentals. If your average stays are 7 nights or less, the bar you need to clear is not this 750 hours of active participation, but material participation. And so that, even if you do have another job, that can happen. There's a multitude of ways to qualify that way. But if you have a short-term rental that you're managing and doing the work on, this can unlock that. And so sometimes that's an option for people who just aren't going to be able to get the hours to be considered a real estate professional. If you have an Airbnb and you're doing a lot of the managing and you can meet these material participation tests, just like that, it unlocks it, and you don't have to deal with this passive activity rule like you do with regular real estate. So that's what I wanted.
It's a unique benefit for being a short-term rental investor.
Correct. Yep.
Yes. Well, cool. I thought you were going to doomsday us for short-term rental investors for a second there, but that's positive, man. I love it. Well, Devin, how can they find you? How can they find what you're up to with your firm and everything? Tell the audience how they can berate you, or not berate you. They can chase you down with tax questions. Berate you if they're mad, but
yes, absolutely. I've been berated before. That's fine. I can take it. it's a tense situation when it comes to taxes. So I'm happy to be people's venting outlets. But best way to reach me or us, we've gotten to the point where we got a big team here, and that's kind of what's necessary to do what we do. Our website's the best place, arrowadvisors.com, spelled like arrow, shooting an arrow, and then advisors.com. Got ways to contact us there. We got a blog. We got some. We'll probably add this to the website. I've made some news appearances. We have that on the website, and that's where you can find us.
Cool. And I highly suggest that if you don't have your go-to person, find that person. Maybe Devon's that person. Devon, thank you for being on. I'll end this episode asking you, the audience, what's one action step you need to take? You guys know I'm asking it. Don't wait. Take that action step today. And if you're currently on your passive income journey, reach out to us. Tell us your story. We truly believe that we can accomplish financial freedom better together. This has been another episode of the Passive 25K podcast with Kyle Reedstrom. If you liked what you heard today, I encourage you to subscribe to our YouTube channel and like this video so we can get more of these conversations out to people that are curious about starting their passive income journey. And if you are thinking about starting your passive income journey, the next steps are to go to our website at p25kg.com and hit apply. This will get you into our application to join our community called Passive Income University, where you can learn everything there is to know about starting and completing your passive income journey. Thanks again for tuning in. I'll catch you next time for another conversation on the Passive 25K podcast.